Esteban Reyes is the founder and general partner of Zenda Capital, a venture firm backing bold entrepreneurs from inception through Series A. His entrepreneurial journey began early, immigrating from Colombia to the US and eventually dropping out of Florida Atlantic University to launch and exit multiple companies that have collectively surpassed $1 billion in enterprise value. Since launching Zenda in 2021, Esteban has become known for his founder first approach, deep operating empathy, and willingness to challenge group thinking. With a concentrated portfolio spanning the Americas, Zenda Capital invests in fintech, healthcare, and supply chain infrastructure. Esteban also remains one of the fund's largest LPs, signaling his strong conviction in the founders he backs. In this episode, Esteban shares why he sees venture capital as a tool, but not the only tool for building a great company, how he thinks about portfolio construction, and why he believes great founders beget other great founders, and much more. Hey, Esteban, thanks for joining us today.
Hey, Mac, thank you for having me. It's awesome to be here.
I appreciate the time, and it's always a pleasure to dive into some of the best investors in the region. So this will be great. Before we get into Zenda Capital and what you guys are doing, I find it very interesting your early entrepreneurial days. If I'm correct, I think you did drop out of college. So it sounds like one of those folklore ideas like, oh my God, I'm going to drop out and it works out. But I think for you, it did work out. So if you want to dive into that first, that would be amazing. Then we can get into some of your investing time.
Yeah, absolutely. I mean, the truth is, I got very lucky. I feel very fortunate. I think things have generally lined up for me, and that's something that I'm always grateful for. Yeah, but it really goes back to my origin story. When I was about 6 years old, I heard the story of a coal miner back in Colombia in the 1940s who one day said, "I want to find a better pathway for my family." And he hacked his way into the U.S. on a cargo plane, got to New York, learned English, landed a job, and became an executive at a company that catered to the oil and gas industry. And then eventually moved back to Colombia and started his own business. And he became very successful and was able to find a better pathway. And that became sort of like a very powerful mental model that shaped pretty much everything that I thought about or did from that point forward. And it was only until a few years later that I learned that this coal miner was my grandfather. And that really cemented this idea of entrepreneurship being a way of expressing potential for humankind. And I knew that I wanted to start a company at some point, and the sooner the better. So I grew up in Cartagena, Colombia, thinking about all these things, always very curious about technology, testing new things. I was the youngest licensed radio operator in the country. And when I graduated high school, I was moving to the US to go to college. And I reminded myself of this story. And the reason I was moving to the US is because Colombia was a very tough place at the time. This was the late 90s. Lots of, problems with drug cartels and so on. But I reminded myself of this coal miner story, my grandfather's story, when I was flying into Miami. And I realized that that was the time for me to figure out which company to start. So I taught myself how to code. And 2 years into college, I was working part time at a company, a lending company, and a company that supported lenders. And I realized that there was an opportunity to optimize the way they verified borrower information. So, like when you go to a bank and you apply for a mortgage, a car loan, or a consumer loan, they ask you often for your social security number, your tax returns, your checking account statements, and so on. And banks go and verify that to make sure that you're presenting accurate information. So all this was manual. And I realized that that was a big bottleneck, and that if solved, it would become not only an efficiency play on the loan origination side, but also fraud was becoming an issue, even though it was masked, especially in the mortgage space. And later in 2008, we learned that, hey, there's a big problem with mortgage-backed securities. So I dropped out to go start this company with two other co-founders. This was in 2001. We started the company pretty much on a bootstrap, raised like 50K from friends and family. Didn't know what venture capital was at the time, and then built it pretty organically to 400 bank customers across the US. And then in 2009, after the global financial crisis had hit, mortgage fraud was a big deal, and we had built, luckily, a really good product and team. So we were in a very good position to sell the company. We got a number of offers and ultimately decided to sell to a company called Lender Processing Services. which then became Black Knight, and today is called ICE, the Intercontinental Exchange, which is a 40 billion plus publicly traded company and the largest provider of technology and services for the financial and mortgage space. So after selling, I was there for a few years, helping plug the company in, ran their fraud solutions division. So had my own experience as a corporate executive and realized that I didn't want to be a corporate executive and left to start more businesses. And that time around, I didn't have like a specific idea that I wanted to go build, but I had the opportunity to spend time with other founders to share, stories about my journey, provide feedback whenever it made sense, and found myself with the opportunity of backing some of these founders without really calling myself an investor. It was more like a founding investor or a co-founder with an expiration date. In hindsight, it would seem more like a venture studio model, but it was just with personal capital. So I ended up helping start 8 companies. The common thread was software and data applied mostly to traditional industries, although there were some things outside of, the software space. And we ended up exiting 3 of those businesses, which combined with the first company totaled $1.1 billion in exit value. So that then led me into wanting to play a more systematic role in backing founders and working with founders. Launched a first fund, 16, and then learned a lot about venture capital through that journey. And that informed what we do at Zenda today, by and large, which is looking for founders as early as possible that are trying to bring modern technology to traditional industries and being their partner of choice, as they plan to go from idea to product market fit.
Wow, a lot to unpack there. I think what's so interesting about what you shared, and obviously I didn't know this beforehand, is so much success from launching and scaling companies and selling without venture. So it's like this irony of, well, you've done it the other way. Why join the venture ecosystem now? Is there some insight you have from your time scaling and I must say like incubating companies where you almost see the benefits of not being venture backed? Do you have any insights on that?
Yeah, I mean, like not every company is venture scale. In fact, there are more companies that are non-venture scale. And I think it's really important to understand venture capital as a resource and as part of the toolkit, but not as the only choice to go and build a company. I'll give you an example. I started a company called FlexiPlan, and what FlexiPlan does is helps motorcycle distributors provide financing at the point of sale to consumers. And this is all a digital experience. We leverage proprietary risk models in order to identify the good borrowers versus the bad ones. And we made the conscious decision that we wanted to self fund that business and grow it organically without raising outside capital. And the reasoning was because we believe that we can achieve a pretty good outcome without venture capital. It would allow us to get to the maximum expression of that business and financial outcome without requiring venture capital. And if we raised money from VCs, it probably mean that we would have to incur dilution, and it doesn't necessarily mean that we will build a bigger business. So I think understanding that since very early on is key. And sometimes it's hard because venture capital has become like this industrialized machine
Yeah.
that puts you on a sequence. If you raise
Yeah.
a pre-seed, then you're on to raise a seed, and if you raise a seed, then you're on to raise the A and the B and the C and the whole alphabet, because now companies stay private longer than ever. And if you haven't really thought through what is the maximum expression of my business and the maximum economic outcome, and what does it mean if I get on that treadmill relative to what I can do with other sources of capital that are maybe non-traditional, including just self-funding it, you may be missing out on flexibility, on optionality, and even also like financial outcome, right? Like if you get diluted and the outcome is still the same, then you left money on the table.
Yeah, it's so interesting you say that because I think for a while people viewed this, in my opinion, as like this validation. Like I got some pre-seed or seed investor, but at the same time, you see this switch now as the ecosystem has changed, where bootstrapping has become sexy again. Moving on, the other business I noticed that you did start, or I guess you could say maybe incubate, was Nova Scale, and I think that was simultaneously with FlexiPlan, correct?
Yeah, that's about right. So, yeah, NovoScale is a tech-enabled services company that provides services to the ServiceNow ecosystem. You may be familiar with ServiceNow as a software company. It has been one of the fastest growing software companies in the last, decade. And what we noticed was that very large companies, mostly all global 2000 companies, adopted the platform and had increasing needs for support around configuration, integration, and maintenance of the platform. And the companies that were offering that support were really focused on just providing consulting services, which are hard to scale, and also didn't have offerings that were fitting the specific needs of the platform as it evolved. So our idea was we would become the top provider of run state support services for companies that had implemented ServiceNow by combining engineers as well as products that would make those engineers more efficient. So we became the largest ServiceNow player offering that model. And then a few years ago, merged with two other companies, raised some private equity money from Sunstone Partners, and merged with two other companies and became a company called Thirdera. And then Thirdera became the largest ServiceNow systems integrator, which we sold to Cognizant a couple years ago. Yeah, it was one of these ideas that we came across and identified as, hey, here's an opportunity to go start a company that is serving a very specific need in a market that is non-obvious, is overlooked, is not sexy, because a lot of people shy away from services. But it was a fantastic journey and a fantastic outcome.
How did you balance? You mentioned we knew that the consulting side wasn't scalable. How did you balance being in the ServiceNow ecosystem, but providing integrations, but scaling? Was that a challenge, or what was the differentiating factor you decided to approach with?
Yeah, I mean, it is a challenge. And this is precursor, like Copilot. So there were three things that we did. One was we built a globally distributed company, although the majority of the talent was concentrated in Latin America. So this was pre-deal, basically, where distributed work became the norm. So we had a lot of internal tooling and process that helped us manage a remote team effectively. The second thing that we did was develop our own tooling that would accelerate the development process, and therefore making engineers more efficient. And then the last thing we did was, in some cases, launch products that would complement the services offerings. So, yeah, I mean, it was at a time where it wasn't as obvious. I think right now, tech enabled services, or a lot of people are talking about services as software, or a tech enabled BPO. There's a lot of voice agent products coming out. There's a lot of products that integrate humans in the loop using AI as a way of making them more efficient. So at the time, none of this existed. So it wasn't as clear cut, but we were able to pull all these pieces together and therefore build a business that was delivering higher value to customers by virtue of faster response times and higher quality work. Have a better financial profile because our engineers were more efficient. We have margins that were 20% higher, or 2,000 basis points higher than a traditional consulting model, and it was more scalable because you would get to do the work of three people with one person.
Yeah, and you mentioned something that was intriguing. Was this was all before COVID and before this remote work and before people all talk about offshoring and virtual assistants. This is like 2015, so a lot of these integrations were very maybe obvious to you, but other people like, what are you talking about? I'm going to have my whole software development team maybe in Brazil, and what is going on here? So moving on to the inception of Zenda, and as you mentioned, enterprise value was well over $1 billion of the companies you started. Was it very keen in the beginning? I want to be, or we're going to be, whoever the backing of this LP is, the majority LP in the fund. Was that the plan from the beginning? I want to put my own capital or some vehicle to work that's going to be the majority of the fund.
Yeah. So, in fact, it started as a vehicle for just investing personal capital. And then it transitioned into a fund with a more traditional GPLP structure. And I think that the goal in saying, hey, we want to have meaningful personal capital at risk here is we believe that, especially when you're backing founders from the 0 to 1 phase, risk alignment is extremely important because it's very easy to write a check and when you don't have a lot of risk on the downside and you're just sharing the upside, to bail and be like, well, this is not working out, I'm going to move on to the next thing, and the founders are stuck with the company, right? And sometimes that makes sense. If you don't believe in the founders anymore, then it's probably reasonable to say, look, we don't see a way of continuing to
Mhm.
work with you, and therefore, call us if you need us thing, but we're not going to be actively involved. But that should be more of the exception, not the rule, or at least have skin in the game so that when you make the investment, it's helping you sharpen your focus and make sure that you're investing in companies for the right reasons and not just to have optionality.
Mm.
So that was one thing. And then the other thing is, we think the job of a pre seed investor, even a seed investor, is probably similar to the job of a founder, just from a different perspective, in the sense that the way that you're assessing opportunity, risks, and so on is through the lens of how you would go build a company. Because a lot of it is, based on, yeah, sure, there could be data and so on, but it's all hypothetical. Is based on a lot of intuition and a lot of sort of decisions that founders typically make just using their judgment instead of analyzing a bunch of data. So, we wanted to be an investor that brought those two things. So, leveraging our experience as founders and operators and putting a lot of our capital at risk to converge as a firm that is extremely aligned with founders since day one, and can bring that same mentality of company builders to help get from, as I said, 0 to 1.
And if I understand, the team's pretty lean. You're the sole, or I guess say sole GP, and then you have a few partners under you, like a venture partner, a head of operations, and then a few research analysts, and then a large advisory team. How does the advisory team play a role? And was it always the intention that you would be the sole general partner?
I mean, I think it's hard to try and form a partnership to start a venture firm. Oftentimes that doesn't work out. And when you raise a fund, yeah, you're signing up for a 10-year plus commitment. So what I thought would probably make most sense was assemble a team that would have shared values, shared vision, complementing skills, and then not have any preconceptions like, oh, I need to be solo GP, or oh, we're going to be a partnership someday. Just let it be, and if people grow and are able to become a partner by the things that they bring to the table, and amazing. If not, then just keep operating as is. So we're open-minded in that sense. What I will say is that even though we're a small team, and effectively I'm the solo GP, everyone in the firm gets exposure to what I would call the sausage making. Like, there's no barriers. Like, I'm looking to get input and feedback from everyone in the team, treating that feedback the same way as if I was dealing with a partner. And the reason we can do it is because we've been very selective in who we bring on, and making sure there's really good fit and alignment and complementing skills across the team.
Yeah, and it gives you flexibility as you guys grow. Getting into the fund now, I think are you guys on fund one, or maybe now maybe fundraising for fund two? And then you basically invest across formation or inception to series A. What's the sweet spot for you guys? Because I know you guys are highly concentrated, check size 500,000 upward. Share a little bit about that and how you view Zenda is coming in and where you're most comfortable with.
Yeah. So the way that we think about it is, if we're going to invest in an idea, we need to have a very high degree of conviction that the team has a 50% or better chance of bringing that idea to life. And usually that comes in a couple of forms. One is, we know the team already because we've worked with them before, we've been tracking them for a long time, and now is the right time to partner. Or the team has an exceptional background that we can validate. So that's how we compensate that very early risk. Otherwise, we probably skew more towards seeing some evidence that whatever the team is talking about has some legs to it, by form of having built a product, already having some demand lined up, having developed some advantage. Or if it's like an obvious idea, if it's a non-obvious idea, then maybe it's more about, do we believe that is viable, and that it makes sense to go against the grain. So yeah, so I think calling it a sweet spot is a little bit of a misnomer. Instead, we try to identify exceptional teams building exceptional opportunities across that spectrum of just have an idea or I have a product and some traction, and identify compensating factors for taking more risk, or if we're taking less, then why is this a good idea, even though there's like a product and some traction? Like, do we believe that we can still achieve the type of returns that we envision for the fund?
Gotcha. And do you guys reserve a portion of the fund for allocation later rounds as far as reserves or follow-ons, or how do you think of that when you're thinking of portfolio construction?
Yeah, portfolio construction is pretty straightforward. 15 to 20 companies, investing 60 to 70% in first checks, and then 30 to 40% reserved for follow-on, assuming some graduation rate out of the portfolio. And we expect that for those that we follow on in, we're going to follow on, through like Series A, Series B out of the fund. And then from that point forward, we have different pools of capital that we can leverage to put more money into, best performing companies.
Got you. I think what you guys do, it's very interesting with this high concentration across different regions and then also across financial services, supply chain, healthcare. I want to ask you, do you ever find it challenging to cover so much territory from investing in Chicago with Cargado to down in Brazil with you guys investing in, I think that, what was the company that you guys invested? Zatlas. Do you find it challenging to cover such a wide region and different verticals?
Yeah, so we are thematic investors. So we follow certain theses that we develop, and our sort of territory is the Americas, but we're less concerned about geographically mapping how we invest and more about finding the best companies that track towards our thesis, regardless of where they're located. So yeah, so I mean, we've not found a Satlas in Miami, right? If we would find the Satlas in Miami, then maybe we would invest in that one. That's a joke. We love the team at Satlas and are happy that we back them. But you know what I mean? Like, we don't constrain ourselves to geography. We just, yeah, focus more on finding the best one.
And I mean, there's always the classic question is like, how with this team that you have, it is very small in some regards. Like, how do you feel like you're finding the best deals? How do you feel like you're meeting the best founders? And obviously, reputation helps a lot, and you guys have built a pretty impressive portfolio quickly. But how do you think about that when you're constructing your portfolio?
Yeah, I mean, it is the question that I think every investor asks him or herself every morning. And I don't think that we ever get comfortable. We're always questioning whether we feel that we're seeing great deal flow or not. We're always questioning how do we make sure that we're seeing the best deals, because this is a game of outliers, as you know. I think that where we see most of our deals coming from is from founders that we know that we work with, that we believe are exceptional. So, we find a little comfort there that usually great founders beget other great founders. And, maybe that's self delusion, I don't know, but we believe that gives us unique access to those deals early on. But yeah, but it's an ongoing question. I don't think we have like a static answer. We're challenging our assumptions.
Yeah, and I came across a quote from one of your founders, Matt Silver, who I've actually followed and interacted with. I'm very impressed with his background in the logistics space, but he made a quote that I thought was intriguing about you guys really challenged him to figure out who his technical co-founder was, and their operating experience was different than just echoing the popular opinions. It takes a lot for someone to say that. Do you find that you guys have cultivated this strength of relationships that's helped with deal flow from just giving honest feedback, or how do you guys be convicted in these early decisions?
Yeah, I think that's right. I mean, it's a little bit self-serving to put it this way, but yeah, like, I mean, I can objectively say that just being upfront with founders in a constructive way, and not just being critical about something, but offering resources that give them options and leverage in solving the hardest problems that they're working on at a given time, is probably the highest value thing that you can do as an investor to build a reputation. Because then when Matt meets Esteban or Mac, and we tell him about our new idea and like how we're trying to figure out getting a technical co-founder on board, or in the case of Jaime, establishing our first debt facility,
Mhm.
then hopefully the Zenda name is going to pop into their head, and they're going to be like, well, you should talk to Zenda. Here's my take, but hey, you should talk to
What's
Esteban and the team at Zenda, and here's why. And we've seen that play out so many times now that I can say with conviction that that's, ultimately what we strive for. We strive for finding those rare opportunities where founders need support, and try to bring our best game to the table to actually help them, and build our name that way by doing the work, not by saying we do something.
Okay, so as you move into different parts of the ecosystem, you guys are evaluating companies now. You're really investing in the software layer. How do you think of AI? How do you think of where the long-term value is? Have you guys laid this out? And where are you thinking your thesis revolves when you see innovation happening so much? You mentioned earlier Cursor and so forth. Where do you think about this when it comes to logistics, financial services within software?
Man, this thing is changing so quickly that is whatever you thought you knew, like, it's obsolete the next day you wake up. And look, if you would have asked me this question 6 months to a year ago, I would have told you that we were extremely excited about the opportunity to bring AI into traditional industries, given that there's very limited data interoperability. There's a lot of legacy systems, and therefore you have a lot of humans working across all these systems in order to execute workflows, right? Think of like call centers, BPOs, and the healthcare logistics space, like it's everywhere. I still think that's a huge opportunity, but it's so obvious now. And there's so many people going after that, that I almost think like the question is like, all right, well, how do you know which are the winners? I don't think I have like a very specific answer, or an answer that I'm convinced that is the answer. But the things I think about are, first, I believe that it's easier now to build a new product than ever. So speed of execution is like so, so, so important. Second thing is pretty much everyone is relying, with some exceptions, but are relying on the same technological building blocks,
Mhm.
ChatGPT, Anthropic, et cetera, specific to AI. So, and there's like techniques that people talk about of how you can optimize LLMs to a specific use case, but it takes time. You got to have a lot of data, and it still doesn't mean that you're going to outperform what's out of the box. So it's hard to tell very early. So I think one real advantage you can have is go to market, right? And the ability to combined with speed of execution. So if you can build product very quickly and execute on go to market very quickly, then I think you have a really good chance of finding a way of building a product that is defensible and unique, and aggregate some of this proprietary data or first party data that would give you that defensibility. And so those are the things that I've been focusing on when I talk to founders, just really trying to understand, you one of those founders that is going to execute faster than anyone else, and do you have already some built-in go-to-market advantage that it's implied, just embedded in who you are or the team that you've assembled? It's tangible. It's not like some conceptual thing like, oh, I'm going to build a community or something like that.
And would you also say distribution in that is super essential as well? Like your go to market needs to have a clear distribution channel, or you're going to get stuck and someone will pass you.
Yeah, yeah, yeah. So when I say go to market, I'm also implying distribution. Yeah, exactly. How are you going to get your product onto the hands of people? I'll give you an example. Right now, like a lot of startups are talking about this forward deployed model where you go into a company, you try to build, some use case using LLMs in order to automate some process to learn about the company, and that's your landing strategy. And then with the idea that you're going to build a platform that makes it replicable, so it's not just consulting work, but you're deploying engineers forward to do that initial work, with the expectation that is going to then feed your broader platform, and be something that you can reuse with other customers. So everybody's doing that. How's that unique? I mean, like, first is going to take, and I'm not saying that's a bad strategy. It can work in some cases, but that, alone is like not enough. Like, if you tell me that that you're Matt Silver, and that you have a network across the whole freight community because of who you are, your trajectory, your brother, then that is like clear that you have an advantage, because you can get to pretty much anyone within the freight industry. Well, it's things like that.
Shifting the last few things here, how do you think now of the geopolitical challenges? I think a lot of people would assume that it's short-term challenges. How does this affect your guys' outlook on the investment opportunities regionally in the Americas?
Man, it's so hard to tell. I think the current administration has made it very clear that um, tariffs and global sort of like tariffs and um, trade is a critical area for um, the policy that has been put in place and that the administration believes in. I think that at least is going to be for the next 4 years. Now, whether all of the things that the administration talks about take place or not is TBD. As we've seen, there's some back and forth. But I think that's going to create still a lot of concern and uncertainty. And whenever there's uncertainty, there can be very big opportunities, right? If you're able to identify them before others, or just have the conviction. I think there's puts and takes, but overall, I do believe that there's a secular trend that is unstoppable where, supply chains need to be more resilient and probably closer to
Yeah.
their home market. And I think that things like nearshoring, even though there's some, headwinds with all the tariff stuff, are going to continue to be a driving force. And like that, there's other examples. So it's a question of like, can you find opportunities where they're compelling enough to overcome whatever confusion and headwinds exist in the market today, and at the same time, during that period of confusion, build towards this longer term, more durable trend that goes beyond the current administration.
Moving on from that point about tariffs and bringing it back into your investment thesis, I know you guys have made an investment in health tech. I'm very intrigued, and I think of quite a few people are with the health tech opportunity in LATAM or across the Americas. How do you see the opportunities there, and do you see just as much opportunity there as compared to maybe financial services or supply chain?
Yeah, so we invested in a couple of healthcare companies, Basara and Cabello. Basara is in the US, Cabello is in Brazil. And the reason we invested in those companies is because they follow a thesis that we had around automating a lot of administrative work within the healthcare space. Because when you look at least in the US, for a lot of specialty clinics, when you look at where they're spending money, a very high percentage of their revenues goes towards administrative work that today can be automated. And we think that's a huge opportunity. So it was less about positioning ourselves as a healthcare expert, and more about following this specific thesis across different verticals. And then in Brazil, Cabello automates a lot of the accounting work and administrative work that independent doctors have to do, because they're registered as they call them pejotas, or independent contractors. And as a result, they got to have a process for accounting and reporting, all of their income and expenses to the Brazilian government. They file taxes, etc. And the traditional way of doing it is manual, which is not great. And the solutions that are horizontal in nature don't cater to the specific needs of doctors. So it was more following that thesis. Now, to your question, I believe that in general, healthcare is such an inefficient market, both in the clinical domain as well as in the administrative space, that I am extremely optimistic and bullish about how AI is already shaping and will continue to shape what healthcare looks like. Outside of making the administration of healthcare more efficient, we've been looking at how AI can optimize clinical outcomes and maybe even prevent certain issues from happening before they happen. And I think there's a lot of stuff in there that is extremely promising. It's not specific to LATAM. I think we're looking at that across the Americas.
Last few things here. As an operator now and basically a full time investor, what's one takeaway you have for entrepreneurs now looking to raise maybe a capital, or maybe deciding, hey, maybe I should bootstrap or invest my own capital? You mentioned a little bit earlier, but do you want to give like a clear feedback on that?
Let me step back for a second. So at the pre-seed, venture capital is the most expensive capital you can ever get. Being extremely efficient, and I say at the pre-seed, but it's before product market fit. Being extremely efficient with that capital and not seeing it as, well, I raised a pre-seed,
Yeah.
I need to get to 1 million or whatever to raise my seed, and then to wherever to get raise my A. Like following the sequence that's been presented by the venture capital industry, not following that, but instead questioning yourself and saying, how can I be hyper efficient with the most expensive capital that I'm raising right now in order to hit whatever milestone to unlock, the next level of value creation for my customers, and then that inform what the next round should look like. And even if you need a round, exactly. I mean, usually you will need a round, but I mean, there's cases where you maybe won't. So it's almost like inverting the script. Instead of saying, what do I need to do to raise my seed? Is what is the best expression of execution that I can accomplish with this amount of money? And how does that reconcile then with the market? Obviously, you got to keep in tune with the market. But if you can get to 2 million, I mean, I'm sure it's like obvious, right? Like no founder's going to say, well, I'm not going to get to 2 million because I want to raise it. But like if you're asking the wrong question, is going to lead you to a bad answer, right? Yeah, so I would spend a lot of time like really scrutinizing that. And then the last thing is partner selection is like so important, especially at this early stage. And sometimes you don't have an option. If you only have one term sheet, then that's what you got. But if you do have options and you can create that optionality, I do believe you can. Like really get to know the people you're about to partner with because you cannot fire an investor. Once they're on your cap table, if they don't want to sell, you're stuck with them.
10-year relationship minimum if it goes well, right?
Exactly.
How has the Zenda Capital thesis evolved since inception? I'm sure you've had a lot of learnings. What has been maybe the evolution of your guys' thesis now?
I think it's been fairly consistent.
Hmm.
What's evolved is the execution. So when we did our first close, it was late 2021. The writing was sort of on the wall, but nobody knew what the timing was as far as when the market was going to shift. So we had to recalibrate the way we thought about underwriting investments, given the new market dynamics. And so that was certainly a big change. And it also meant like being extremely patient because if you recall, during 2022 and a good portion of 2023, early stage market was still like on fire. The late stage market and the public markets were crashed, but the memo wasn't yet received by, pre-seed and seed investors, at least a vast majority of them. So I think now is much more normalized. And that also had to do with the amount of capital flowing into early stage because as later stage companies started to suffer, many investors shifted their focus to early stage, right? So they got the party going. So we had to realign on the timeline to deploy the fund. But in hindsight, I think that's been like a really good thing because we have very little exposure to 2021 and 2022, and we have more capital to deploy now in a market that seems more rational and just more favorable.
Perfect. Last question. What are you most proud of to date in your career? And then coupled with that, what has been some of the biggest learnings?
Yeah, I think the thing I'm most proud of is being able to write my own version of this story that I told you about, the coal miner story, and kind of find my own pathway. That is the thing that I'm most proud of. And I'm by no means saying that I've made it or anything like that, but it's been a fantastic experience. I see every company that I get involved in or have the opportunity to start as a work of art. And I'm extremely proud and grateful for having the opportunities that I've had of participating in the companies that I've been part of. Man, biggest learnings, partner selection, as I mentioned before, is like so critical. And it doesn't mean that there's good and bad people. I just think there's different visions, and making sure there's strong alignment since very early is sometimes feel like a waste of time or soft, but it's like it pays. Like in the long term, pays greatly. And then yeah, I made many mistakes like that. Like I've gotten into places where I maybe should have not been. Yeah, and then the other thing which goes with that is incentives. I think this is attributed to Charlie Munger, who rests in peace. Is like, show me the incentives and I'll show you the outcome. Is what that. So I think that's so true. And oftentimes, if incentives are ignored, then things can get off the rails. Even if it's unintended, it can be like really bad.
That's a wrap on this episode of Cut the Check, presented by VCMX. If you enjoyed this conversation, I would really appreciate it if you subscribed and leave a review. It really helps more founders and investors discover the show. You can find me on LinkedIn at MacMeyer or check out my website at macmeyer.com for more insights on startups, venture capital, and the Latin America ecosystem. Thanks for tuning in, and I'll catch you next week.